SoFi Technology stock is trading live at $17.98 per share, moving within an active intraday range with the market open on August 12, 2026. While the broader public assumes that online banking stocks rise and fall purely based on consumer lending habits and basic interest rate cuts, the hidden reality is that the actual valuation mechanics are increasingly tied to high-margin software platform services and technological infrastructure licensing that most retail traders completely overlook on a day-to-day basis. When you look at popular platforms like Robinhood, SoFi Invest, SoFi Investing, SoFi Stocks, SoFi ETFs, SoFi Robo-Advisor, SoFi Active Investing, SoFi Trading Platform, and compare them with alternative trading venues like Interactive Brokers Trading, Interactive Brokers Platform, Interactive Brokers Fees, Interactive Brokers Account, Interactive Brokers Stock Trading, and traditional setups involving individual brokerage, Fidelity Investments, Fidelity ETFs, Fidelity Mutual Funds, Fidelity Brokerage, Fidelity Wealth Management, Fidelity IRAs, Fidelity Mobile App, Fidelity Trading Platform, and Robinhood Stock Trading, Robinhood App, Robinhood Investments, Robinhood Crypto, Robinhood Cash Management, Robinhood Fractional Shares, along with automated advisory alternatives such as Schwab Intelligent Portfolios and Intelligent Portfolio Options on various investing sites designed for online investment and online investing with proper investment help for self-investing where users prefer to invest online. You notice a massive shift in how modern financial services operate. Most casual observers believe that digital lenders are merely risk-on consumer finance plays susceptible to every micro-fluctuation in macroeconomic debt defaults. But the underlying data reveals a technology company scaling its enterprise software division at a pace that fundamentally alters its long-term financial profile. If you look at how people approach asset management today, whether through an individual brokerage or specialized digital portals, the consensus view is that online banking applications operate on thin lending margins that shrink rapidly when borrowing costs shift. Yet the reality captured in recent quarterly numbers shows that fee-based technology segments, cross-buying habits among members, and robust enterprise platform partnerships are doing the heavy lifting to insulate margins against credit cycle volatility. Daily swings in the equity show heightened sensitivity to short-term sentiment, but the broader institutional volume indicates that professional allocators are tracking the stickiness of the digital membership base rather than just headline loan origination numbers. When evaluating the broader fintech landscape that includes automated tools like Schwab Intelligent Portfolios, alongside self-directed options on platforms like Robinhood, Interactive Brokers Platform, and Fidelity Trading Platform, the competitive moat usually comes down to user acquisition cost and ecosystem lock-in. People often assume that acquiring new financial consumers in a crowded digital marketplace is becoming prohibitively expensive due to rising customer acquisition expenditures across digital advertising channels. However, the exact opposite is happening within this specific ecosystem, where cross-selling lending products, credit cards, brokerage accounts, and cash management services dramatically lowers the blended cost of acquisition over a customer's lifetime value. This creates a powerful financial flywheel that traditional legacy institutions struggle to replicate because their legacy tech stacks prevent seamless cross-platform product adoption. Comment below how many shares of SoFi stock you currently hold in your portfolio. To truly understand where this equity is heading, we have to look past the superficial noise of daily market fluctuations and examine the structural mechanics of the business model. Founded with the original intent of disrupting student loan refinancing, the company has methodically expanded into a full-service digital financial super app that handles everything from high-yield savings accounts and personal loans to debit cards, mortgages, and automated investing services. By securing a national bank charter a few years ago, the enterprise fundamentally transformed its funding cost structure, allowing it to hold deposits directly and lend out its own capital rather than relying entirely on expensive warehouse lines of credit or third-party bank partners. This structural evolution changed the margin profile permanently, yet market sentiment often reverts to treating the company like an unproven startup rather than a fully regulated financial institution with a rapidly expanding deposit base. Looking closely at recent trading volumes, institutional sponsorship has remained relatively resilient despite broader sector rotations out of high-growth financial technology names. Macroeconomic pressures, including shifting expectations around central bank rate paths and employment data releases, continue to trigger sharp intraday volatility, but the underlying operational execution has consistently beaten consensus estimates over successive quarters. Bears frequently point to potential credit deterioration in unsecured personal loans during an economic slowdown as the ultimate Achilles heel for the stock, arguing that rising delinquency rates could wipe out lending profitability. The counter-reality embedded in the numbers is that the average demographic utilizing these digital platforms tends to have higher than average FICO scores and strong income profiles, which historically demonstrates better resilience during economic contractions than subprime-focused consumer lenders. Furthermore, the technology platform segment, known as Galileo and Technesis, provides software-as-a-service infrastructure to other financial and non-financial brands, generating recurring, high-margin revenue streams that do not carry direct credit risk. This dual-engine model, combining direct consumer financial services with business-to-business technology infrastructure, separates the firm from traditional banks and monoline fintech competitors alike. When comparing execution against expectations, analysts frequently underestimate the compounding effect of member growth on the platform ecosystem. As more users download the mobile application to manage their everyday cash, the propensity to adopt secondary and tertiary products increases exponentially without requiring proportional increases in marketing spend. This organic cross-buying behavior is precisely what drove the consecutive quarters of positive GAAP net income, silencing long-standing critics who claimed the business model could never achieve sustainable profitability at scale. Looking toward the future outlook, several key catalysts and risks will dictate the trajectory of the stock over the coming quarters. On the opportunity side, continued expansion of the B2B technology segment into international markets and broader enterprise verticals offers significant upside that is only partially priced into the current valuation. Additionally, any regulatory clarity or favorable legislative changes regarding digital assets, payment processing fees, or automated advisory services could act as an immediate tailwind for user engagement and transaction volumes. On the risk side, persistent inflation prints or unexpected spikes in unemployment could drive credit loss provisions higher, forcing management to tighten lending standards and temporarily slow revenue growth in the consumer lending division. Competition remains fierce, with legacy banking giants aggressively upgrading their mobile applications and nimble neobanks vying for the same demographic of digital-first consumers. Yet the comprehensive nature of the ecosystem, allowing members to borrow, save, spend, and invest all under one unified digital roof, creates a sticky user experience that reduces churn. In summary, while the prevailing market narrative often reduces the equity to a volatile proxy for consumer credit health, the deeper operational reality points to a multifaceted digital financial powerhouse transitioning steadily into structural profitability. The tension between cautious market expectations and resilient underlying operational growth continues to define the trading pattern of the stock, offering a compelling study in how modern financial technology firms scale past their early-stage burn rates. As the broader financial services industry undergoes a permanent migration toward digital-first architectures, the ability to successfully cross-sell high-margin software services alongside traditional banking products will remain the ultimate determinant of long-term shareholder value.